With many big-name stocks plunging into bear territory and fears of a systemic debt crisis a la 2008 driven by investors' once insatiable appetite for yield, we want to know, is this recent market sell-off just a sell-off, or is there something bigger and more problematic going on? Well, the guy who knows more than anyone about debt markets is legendary bond investor Bill Gross, portfolio manager for the Janus Global Bond Fund, and he is here right now with a look at how you can best position yourself. Bill, welcome.
Hey, Trish. Good to be here.
You know, I got to say, it's a really tough market right now, but I know your fund has beaten about 80% of your competitors since you started. So first of all, a big congratulations to you on that.
Hey, thank you.
And second of all, we want to know how you've done it.
Well, we've done it by lots of research, lots of hard work, and being conservative. You know, obviously in the past several weeks, in the past several months, markets are moving down as opposed to up, and it's just what we expected. We basically were looking at a highly levered global economy that was subject to, you know, pockets of downdrafting in terms of prices once the Federal Reserve started to raise interest rates, and we're seeing just that. And so it's a conservative fund. It isn't intended to yield 5 or 10%. It's intended to basically save your money and to earn a modest return, and that's what it's doing.
You know, Bill, over the last couple of years, you have repeatedly told me that you were worried about the dangers of central bank planning, that you just couldn't sort of leave the spigot on forever, and there are a lot of perhaps unintended consequences of leaving interest rates too low for too long. Do you think the chickens are coming home to roost right now?
Well, I think they are, and there are negative aspects to low interest rates as opposed to positives. You know, the positives would be your mortgage is cheaper at a lower interest rate and you can buy a bigger house. The negatives basically are that savers, you know, your viewers who have invested their deposits in banks for the last 6 or 7 years at basically 0%, you know, basically are getting short-changed, and that extends not only to individual savers, but insurance companies, pension funds, and other institutions that need higher interest rates. And so, yes, chickens are coming home to roost, so to speak.
How big a deal could this be? I mean, we've had some people on the show, and I want to get your perspective on this, that are quite concerned, because the feeling is the Fed is out of ammunition right now. Our economy is still in lousy shape, and there's all this high-yield junk out there that could potentially default. I mean, you think about MLPs and, you know, some of the loans that maybe have been made to Chinese companies, some of the sovereign debt that exists out there. What's your view of the credit quality situation for some of these?
Sure, those are excellent points. And I would say from 30,000 feet that there's simply too much supply relative to demand in the global economy, not just in oil, but in most commodities and related investment in producing them. And, you know, that supply has been fostered, as we mentioned, by years of 0% interest rates and quantitative easing. At the moment, you know, policymakers, which include central bankers, you know, they have no conceptual model to explain why 0% interest rates produce relatively little, if any, growth. And, you know, they look to the job market and they fear inflation, you know, 2 or 3 years forward, yet financial markets expect much less than they do. So, you know, I think part of the problem is monetary policy. It's reached sort of a dead end. I think central bankers are following the wrong roadmap and are reluctant to call home for directions.
Are you worried about a credit crisis, a debt crisis, similar to what we saw, different from, but similar to 2008 at all?
Well, we see that in certain pockets around the globe, and you see a potential crisis when you have too much debt. In the United States, you know, debt has been reduced in terms of household debt. A lot of mortgage debt has come down. Some of it is as a result of defaulting, but in any case, the homeowner, the U.S. consumer, is in a relatively good position with low interest rates and low debt. So I don't worry about that. There are some countries, however, that have taken on a lot of debt. You mentioned it a few minutes ago. You know, Brazil, for example, in dollar-denominated terms, and as the dollar appreciates and their currency goes down, that means their liabilities go higher and higher and higher. And so, you know, there are pockets around the world where there's a lot of debt and it's dollar denominated, and we're seeing some of that in terms of the problem areas in markets.
Does it matter to us, though? I mean, you know, if Brazil's struggling, or even China for that matter, how much should it matter to U.S. investors?
Well, it should matter a lot because the markets these days and these years, you know, not 20 years ago, but these days the markets are basically interlinked and interconnected. And they're relatively highly levered too, meaning hedge funds, meaning you know, investors that have borrowed money in order to take higher yielding positions. As prices come down, but this isn't hard to explain, and it's relatively easy to understand. As prices come down, there are margin calls, and levered investors basically have to sell things in order to meet margin, and sometimes they even sell high-quality investments because those are the easiest things to sell. And so, you know, high debt basically leads to a downdraft when interest rates start going up.
Okay, so if you're one of those worried investors right now that is scared about this scenario you're playing out, I just have 30 seconds, but what would you tell them to do?
Well, you've got to be safe, and you've got to buy assets at a discount. I like closed-end funds where you can buy assets at 85 to 90 cents on the dollar. Best example, BBN is the symbol, BlackRock Build America, semi-guaranteed by the United States of America. It yields about 7 to 8%. You know, does that mean the price doesn't go down? No, but it's been relatively secure and safe, and I'd recommend that.
Thank you so much. Good to have you here, sir, as always.
Thank you.